Hey there, it's Mitch Goldberg. Welcome. I'm so glad we got the introduction out of the way first. Happy Monday. Welcome back to another week. Welcome back to the second week of 2023 and the first full work week. So everybody's trying to figure out what's going to happen for the stock market this year. Like, and some people are actually believing their own bullshit. Like they know. Well, if the first 5 days of the year the stock market's up, that portends for the market to do well because when the market's down and the first 5 days of the new year are up, 85% of the time the stock market has gone up. Well, it makes sense because typically speaking, the stock market typically rises in a year, much higher odds every year of a rise than a retreat, historically speaking. And while we're talking historically, we do have these recessions, bear markets, and other financial calamities. And everybody's like girding up, like, we could have a recession. We could have well, we're already in a bear market. But like, I don't know why people are acting like this is the most shocking news ever that we could have a recession or they're going to cause a recession or this is going to cause a recession. Recessions come and go. They happen all the time. And everybody's acting like they've never seen this before, but we have seen this before. And it's like true to form. We've been talking about this for like the last couple of years here on Be the Boss of Your Money. And we're going into another one if we're not in one already. And what's a recession going to be like? I mean, it's, is it going to be a hard landing, a soft landing? And, it's today the soft landing crew and this past Friday, the soft landing crew is, out in the lead. The Dow is up 700 points last Friday. The major averages, the Dow, the S&P 500, the NASDAQ composite, they're up, all over 2% on Friday. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And today, the Dow backed off a little, S&P backed off a little, NASDAQ just up a little bit, basically beating down stocks. Tech stocks in particular still had a little oomph left in them today. Tesla went up today. So that's what that was. Does it mean anything? Okay, so today's the fifth full trading day of the year that just ended. We're up for the year. Well, we're down 4 out of 5 days. Does that mean anything? We just had one really good day on Friday. All this stuff, folks, is just nonsense. The stock market typically does rise most years. So it makes sense that if you start the year every year and say, the stock market's going to go up this year, let's make that prediction right now. If you do that every year, and if you're like in the business as long as me, over 30 years, you would have a great track record of making these terrific investment calls, these market calls. So why not? Let's make the call. The stock market will be up this year. Let's just make this call every year, and eventually, we'll be more right than wrong. But everybody's getting themselves worked up because they're trying to assert some kind of control. And that's a big thing for investors. We like to have some kind of control. And when the market's going up and up and up, and your account is getting bigger and bigger and bigger, and you're starting to feel like, holy cow, who the hell am I? I've got all this money. Look at me. I'm starting to feel wealthy. It's easy to start to feel very bullish and optimistic. It's everything's working out. I don't see what the problem is. Everybody's not doing it like me. They should be doing it like me. And then you realize interest rates go up. The rug gets pulled out from under you. Everything goes down. You lose basically all the money that you ever made in Amazon or Facebook or Google or whatever. And then you're like, wow. Hopefully you realize that you're just like everybody else. You're riding the wave of lower interest rates and a flood of money finding its way to the stock market. It's not always like that. I'm not saying every bull market is because of the Fed and it's because of a flood of money just finding its way into the stock market, kind of like just blindly finding stocks to buy. But at the end of a major bull market, we do often get these what we call blow-off tops, where it just becomes funny money. It becomes speculation, where things that ordinarily wouldn't go up or that ordinarily wouldn't be found to be attractive to investors become very attractive. And that's how you come about with things like meme stocks, SPACs, and crypto. Until, the interest rates go up, the easy money is out, and then the stuff that looked insane going up, which people start to accept as normal, that stuff gets killed. And it's just a stark reminder every time. Oh, yeah. I'm not trying to, like make fun of you or to say, people are dumb. I'm not trying to be like that. I really am not. I'm just trying to say we go through these cycles. So if we go into a recession, people go, oh, the Fed's going to cause recession. The politicians are going to cause recession. The stock market people, they're going to cause recession. The stock market people. I would really like to know who they is, like some general term. They, there. This is just everything is cyclical. It's all cyclical. And we ran through a cycle of liquidity, and there's a hangover to pay for it. And we're going to go into a recession. Um, Last week, it was very I would say you should be expecting recession. I know people are now getting into like the whole soft landing business, but the economic stats are showing a weakening economy. Like on Friday, we had the employment figures, non-farm payroll came out. Job creation was pretty good, a little better than expected. Wages came in a little bit lower than expected, but still positive. That got people excited. But then what got people really excited is the PMI service figures came out and show that the service sector just went into a contraction, and people got all excited and bid up stocks. I know what you're thinking. Shouldn't people be upset about a contraction? Isn't that bad? People lose jobs. Yes, it is. But for investors, that means the Fed eases off the brakes and stocks should finally catch up and go back up if the Fed starts to ease interest rates. Lower rates means companies' future earnings are worth more in today's dollars. So rates go down, all of a sudden the companies are worth, more in the future, and the stocks get bid up right away, meaning investors buy them and the stocks go up. And it happens quickly. But economic statistics are showing slowing. So the general wisdom, the conventional wisdom right now is we're going to get a slowdown, softer hard landing in the first half of this year, and we come out of it in the second half of this year. The Fed at that point will no longer be raising rates and will probably look to cut rates by the end of this year. And so why sell anything? Why do anything? Let's just chill out and wait for that story to, follow through, for that story to become true, and everything will be okay. And I actually don't think that's a bad thing. As a long-term investor myself and guiding my clients through the stock market with long-term holds, I find holding off on doing anything drastic because we may or may not go into recession is very appealing. I'm going to wait. That's me. I wait. The investor in me says, just wait it out. I've got good stuff, and I'm willing to wait it out. I'm comfortable seeing my account go down while I'm waiting for better times. You know why I'm comfortable? A lot of people would say, why are you comfortable with that? Because we expect it. It's built in. When I talk to a client about their portfolio, it's always, there are going to be times when we're down. It doesn't mean you're in the wrong portfolio, and it doesn't mean you do something to make something happen because you have you want some false sense of control. We just wait it out. We're diversified. We wait it out. Diversification is a strategy that you could use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. You could probably memorize that by now, right? So that's where we are. Soft landing, hard landing. Everybody's just going to wait out for the Fed to finally cut rates. So nobody really wants to do that much. And as a result, the market was, it held up okay today, considering how much we were up on Friday. And numbers weren't anything great. In fact, if anything, economic numbers are coming in a little bit weaker. But again, that's positive because it means the Fed could stop raising rates. Let's take a look at a few stocks of the day. All right. We get rid of the icons over there. All right. Boeing was down 4. All right. Merck was down 4 and change. And Johnson & Johnson was down 4 and change. Is this the day that I'm picking stocks that are down $4 and change? No, it just happens to be that these are 3 blue chips in the Dow Jones Industrial Average. They have been leading the Dow up. So is Caterpillar. They've been doing phenomenally well. All of them have been hitting either hitting year highs or close to highs. But today they backed off because the biggest winners did that. They do that sometimes. The biggest recent winners. I'm not making a call if these are going to continue to be winners or not in the near future. That's up to you. And I don't like to make stock calls on this show because I don't know who's watching the show. And I could say something that could be bullish to me, but grossly inappropriate to somebody watching. And then they buy it, it goes down, and they're like, oh, they're upset. Okay, we have to avoid that. If you want to talk to me individually about stocks, definitely reach out to me and we'll talk about that. Anyway, these are the stocks that were leading, and it was just a little bit of a reversal that these are the stocks that tanked. But the market wasn't down that much. The Dow was not down um, anything that serious. Okay, so not particularly worried about that. Okay, I'll just tell you what how the Dow looked today. All right, all right. So Merck was down over almost 4%. Johnson and Johnson down 2.5%. Travelers, Boeing, Amgen, Coke, Walmart. Most of them are down, and the ones that are up today were, not that up. Salesforce is up a little bit, Intel's up a little bit, but then again, these stocks have gotten absolutely freaking hammered lately too. Goldman Sachs is up a little bit. They have announced layoffs that people have been getting ready for a long time, and no big deal. Let's take a look at how the major averages did, though. Again, Dow down 112, Nasdaq up 66 points, not a lot. S&P down 0.08, so just about flat. Oil was up a little, gold up a little, interest rates off a little bit. The VIX hanging in there at 21 and change. Okay, and let's take a look at bonds, bond market. Yields are still coming down across the board, but 6 months now, you're getting 4.8% for a 6-month T-bill. 4.7 still, over 4.7 for a 1-year T-bill. Short-term rates are like really attractive compared to dividends, compared to long-term interest rates. I'm talking treasuries. They're safe. Yeah, I could say that. They're safe. T-bills are guaranteed, backed by the full faith and credit of the United States. All right. Um, I don't know what people are wasting the time for, like buying corporate junk bonds. The problem with corporates, especially junk bonds, is that if we do go into a soft landing or a hard landing, which meaning a full-blown recession, companies go bankrupt, credit risk of defaults go up, and corporate bonds do poorly. So do you really want to be buying corporate bonds now ahead of that when you could buy a T-bill for a decent yield? And not only is it free from it's free from state taxes, not federal, but state. So I have my own views on how we should do these things. And if you want, give me a call. We'll talk about them. Okay. And that is really about it for the day. It was a very quiet day. Thursday, we have inflation figures coming out. Um, we had a couple of statistics that were a little bit weaker. It shows that the economy is starting to slow down from its pretty brisk pace. The question now is how quickly does it come down? A lot of people feel now that we're in the first quarter, you're going to see a lot of layoffs hit in technology and financial services, especially. And these are high-paying jobs. They're not the easiest jobs to just get a new one when there's mass layoffs going on in the industry. We shall see. In the meantime, you can't find a car if you want it, because I know I'm shopping for a new car. You can't find anything. There are still shortages. Things are still expensive. And I think we need to stop trying to um, take control of things we can't take control of, especially with regard to the stock market. You just can't do anything about it. So control other things like how much you invest every month. Control if you should rebalance your portfolio. Control if there's a stock or fund or something that's no longer fitting the bill of what you need. Get rid of it and replace it with something that does fit your bill or fill your bill, whatever, with what you need. These are the things that you could be doing. You could be studying up on what's the best Medicaid parts you should use. So many things to be doing in personal finance that we seem to spend so much time on the stock market, which as the only true wealth generator in your financial plan, I understand it. but everything else is about efficiency and saving money, and those are important too. Okay, that is about it. I so greatly appreciate your time. I will be back tomorrow with a full episode. And until then, thank you very much for watching.